Which Singapore bank offer the best value for investors right now? That's what we're gonna find out today. Hi guys, Stanley here. I'm the co-founder of valueinvestation.com, an investment portal where we'll give you investment news and in-depth analysis of listed company every single week. So if you're new to this channel, remember to hit that subscribe button so you'll not miss out on any of our videos. The Singapore financial sector is led by our three local banks. They are DBS Group Holdings, Overseas Chinese Banking Corporation, and United Overseas Bank. These three major Singapore banks play a key role in building up Singapore as a financial hub in the region. The strong rule of law and the governance in Singapore has created a stable environment for these banks to flourish. Today, these three banks are the largest company within the Singapore stock market, contributing about 44% weightage to the Straits Times Index. It seems that as long as Singapore continues to be a key financial center of the region, the potential of these banks are still far from over. So, all of them with great long-term prospect, they are all fairly attractive to investors. But the question today is, which one has the best value for you right now? With the help of Share Investor Web Pro database, we're able to find that answer. Share Investor Web Pro is one of the best value for money data provider out there. The web-based software means that I can access this database anywhere. It allows me to look through about 10 years of financial data of a company, and it even allows us to compare a few companies all at once, and which is a feature that we will use for this comparison. As someone who invests across multiple markets, Share Investor Web Pro really got me covered with their database spreading across multiple markets like Singapore, Malaysia, Hong Kong, US, Australia, and even the Indonesian and Thailand market. And the most exciting thing is that Share Investor is giving you extra bonus when you sign up with them right now. For example, if you sign up today, you will get an extra $30 Grab voucher from them. But the special offer is only until 14 August, which is just 2 days away. So if you want to find out more, remember to click on the link below before the offers run out. Thank you Share Investor Web Pro for sponsoring this video. Now, back to the show. Alright, in order to analyze all three major banks in Singapore, we have to look into all the important differences between them. Firstly, let's look at their shareholder structure. The major shareholders of DBS Group is Temasek Holding. This makes it the only government-linked company in this group. But that's not necessarily a bad thing. Compared to other government-linked companies within Temasek portfolio, DBS Group has been one of the best performing companies over the past decade. The company also has a long history of successful transition between management, so there is definitely a plus sign for DBS. On the other hand, UOB has a number of major shareholders, but is still predominantly owned by the Wee families, with the Lian family and Tai Tak Estate being its large shareholders as well. One downside for UOB is that its management has always been firmly in control by the Wee family, so there's a lack of clarity in terms of succession planning for the bank for the long term. Lastly, OCBC counts its founding family, the Lee family and their Lee Foundation, as its major shareholders. I see OCBC having a structure somewhere between UOB and DBS. Although they still have a founding family as a major shareholder, the company has seen a few successful transitions in management already. Today, the company has just gone through a change of group CEO to Helen Wong, previously is head of global wholesale banking. So in terms of succession planning, OCBC and DBS Group do seem less risky than UOB in this aspect. Number 2, revenue. All three banks still generate most of their income in the traditional way, from interest income earned from their loans. You can see that UOB has the largest portion of its revenue coming from interest income, while OCBC has the least. Apart from interest income, there are slight differences between how the three banks obtain the rest of their revenue. UOB counts wealth management as its next large contributor, generating about 8% of revenue last year. OCBC also sees wealth management as the next largest contributor at 11%. However, it also has a sizable insurance business, which make up about 9% of revenue last year. DBS Group, on the other hand, only see wealth management as its third largest revenue contributor at 10%. In 2020, its second largest contributor is actually coming from net trading and investment gains, which contribute about 16%. However, that revenue stream might be more volatile in nature. So from looking at their revenue split, I do feel that OCBC might be the one with the most balanced revenue stream from both interest income, wealth management, and insurance. So another win for OCBC in this aspect. Number 3, loan breakdown. Since all three banks depends heavily on interest income, it is important for us to look into their loan exposure. In terms of the industry, the largest exposure for all three banks are the same. Close to 50% of their loans are related to the housing and construction sector. Beyond that, that is where the differences start. OCBC is more exposed to the consumer market at 11% of their loans are given out to individuals. UOB on the other hand give out a significant portion of their loans to other financial institutions, while DBS is more exposed to the manufacturing sector. When we look at their geographical split, again all three banks still have the majority of their loan in Singapore. However, DBS Group has the largest exposure to the Greater China region, close to 30%, with its loan coming from Hong Kong and the rest of China. OCBC and UOB both have similar exposure to the Greater China region at around 16%, with the rest of that coming from Southeast Asia region. So for this segment, no one bank has the advantage over the others. It is up to us to see which region and industry that we are more comfortable being exposed to. Say for example, if we prefer to invest more into the Greater China region, then DBS Group might be the one that gives us more exposure to that aspect. Number 4, profitability. A special way for us to measure the profitability of a bank is using the ratio called net interest margin, or NIM. We can see NIM as basically the interest spread between what the banks pay out to depositor and what is earned from its loan. This means that a bank with a higher NIM is earning much more from its loan. In this area, all three banks actually have very similar net interest margin, with DBS just edging out the rest at 1.62% last year. However, the differences is so small that I will see them as all very similar. The other margin that we can look at is their net profit margin. For 2020, all three banks also achieved very good net profit margin, even with the pandemic raging on. Out of the three, OCBC shows the best margin at 35% for the year. So in terms of profitability, again, OCBC might be the winner here. Number 5, return on equity. Return on equity is one of Warren Buffett's favorite ratio when evaluating a company. We have done a video explaining what is return on equity and why it is important. So if you want to learn more about it, remember to check that out as well. But essentially, return on equity tells us how well management is able to generate more profit from the company resources. So a higher return on equity means that the company is better managed in terms of generating more profit for shareholders. Looking at their last year result, DBS Group is the clear leader in terms of return of equity with more than 9.2%, compared to the 7% the other two banks have achieved. Number 6, growth. Growth is important for all companies. To me, if a company is not growing, it is basically slowly dying. That is because our money is shrinking every year due to inflation. So if a company is stagnating, its business is actually shrinking. Luckily, all three banks have shown growth over the last decade. But again, DBS Group seems to be the one that is growing the fastest. It grew its revenue at 7.5% a year over the past decade, while its earnings per share grew around 4% a year over the same period. Number 7, valuation. Lastly, one more aspect that we like to consider is their valuation. For banks, I like to use simple valuation guides like the dividend yield or their price to book ratio. As all three banks are quite consistent in their dividend payment, looking at their dividend yield would give us a rough idea on what kind of cash flow return we can get from investing in them. At the moment, all three banks have very similar dividend yield ranging around 2.5% to 2.9%. There is a larger difference when it comes to their price to book ratio. Price to book ratio of a company is just its share price over the company net asset per share or book value. Therefore, with a lower price to book ratio means that the company is generally cheaper. I like to look at the net tangible asset, which cancel out all intangibles of a company when comparing that ratio. So looking at data from Share Investor Web Pro, I can see that DBS Group has the highest price to book ratio right now at 1.7 times, while both UOB and OCBC are trading around 1.3 times their net book value. This means that DBS Group is the most expensive bank right now among the trio. Maybe due to their higher growth, investors are valuing the company much higher as well. So which has the most value right now? When looking across all the criteria we talk about, we can see that DBS Group is the bank for growth investor, having shown the best growth rate over the past decade. It also has a higher exposure to the Greater China region, which might also have more growth potential for the company. However, it seems that OCBC might be the one offering the best overall value right now, with a more balanced revenue stream to higher profit margin and also lower valuation. So what are your thoughts on the three banks? Let me know which one will you choose. And let's discuss, do you think that the rise of digital bank in Singapore will become a serious threat for these three incumbents? And remember, you can check out all financial information about the banks and also other useful tools like analysis indicator and consensus estimate within Share Investor Web Pro. The offer for Share Investor Web Pro is only until 14th of August. So if you sign up over the next 2 days, you will get to enjoy offers like cash vouchers, free reports, or discount to their subscription. If Share Investor Web Pro is the tool you need, remember to check it out on the link before the offers runs out. As always, my name is Stanley. Till we meet again, invest safely.